Hi, I'm Anna Hilberry with National Bank Financial. It's March 29th, 2019. Today I'm talking about the inversion of the yield curve in Canada and in the US. Investors may be wondering, what does this mean for you? What does this mean for your portfolio? And what should you be doing about it? One thing we can all agree on is we are late in the economic cycle, and the economies in Canada and in the US no longer look as rosy as they once did. We need to be focusing on high quality companies in your fixed income and in your equity portions of your portfolio. You also want to be looking at the balance of the overall portfolio and being mindful of how that will affect you with price swings going forward. So when you're looking at your equities, you want to ask yourself, why do you own the companies that you currently own? Were you speculating? Were you chasing growth? Were you looking for dividend income? If you are speculating, that is a dangerous thing to do at any time of the game, particularly this late in the cycle. If you are chasing growth, you want to be very careful that you do not overpay for companies at this point in time. Let's take Cisco Systems, for example. They're a really great company. They've paid solid dividends, they've had solid earnings. If you overpaid for them at the peak of the market in 2000, you would still be underwater. So that kind of a error in judgment can be very hard to overcome, and it can take a very, very long time. For your growth positions, do they represent a balloon position in your portfolio? For example, did you buy some of the FANG stocks? They've done very, very well, and they're representing an overly large position. We want to ensure that the different industries in our portfolio have a nice array so that we are reducing risk, and we want to focus more on companies that have a positive earning history and have positive earnings today and are more defensive. When we're talking about your bonds, if you're a retail investor and you don't have a financial advisor, it's unlikely that you're holding individual bonds in your portfolio. So you need to be careful that if you're holding a pooled product, that the yield that you are getting is from high quality companies. So for example, if you have an interest rate of, let's say, 2% and you're earning a 8% yield on your bonds, there is a pricing of risk in there. So you're getting paid for that risk, and so just be very careful. If we have a downturn in the market and we have a recession, earnings of the underlying companies will decline, and that can have a very large negative effect on certain types of companies. You also want to be careful that you have companies that have been through a recession. Is this a cannabis stock that is just a new startup? You don't know how that's going to, relate to them down the road. So is it time to sell out your portfolio? Absolutely not, but it is definitely time to focus on quality. I'm Anna Hilberry. Enjoy your day.